Good evening, and thank you for joining me. As we speak today, global financial markets look calm on the surface. Stock markets are trading inside familiar ranges. Volatility remains low. Bond markets are still functioning. Central banks continue to speak in measured, routine language. Everything appears normal. And yet, beneath this surface calm, something unsettling is taking place. Not in headlines, not in press conferences, not in emergency announcements. It is happening quietly inside balance sheets, settlement systems, and reserve decisions, especially in the global gold market. Nothing has visibly broken, but the structure that supports confidence in the financial system is beginning to feel stretched. Over the past several years, a clear pattern has appeared. Whenever trust in the financial system weakens, even slightly, three things tend to move first. Official gold reserves change, settlement and collateral rules are adjusted, and liquidity behavior inside the system shifts. These are not signals meant for the public. They are signals used by institutions. The numbers help explain this. Gold has moved from below 1,800 to above 2,000 per ounce without a major collapse in real interest rates. Central banks bought more than 1,000 metric tons of gold in a single year, the largest amount ever recorded. Registered gold inventories at COMEX have fallen by tens of millions of ounces from earlier highs. And under Basel III rules, physical, allocated gold was quietly reclassified as a Tier 1 asset. These are not emotional decisions, they are technical, balance sheet decisions. And they suggest that the common market narrative is incomplete. Central bank gold buying has become steady and deliberate. Reports from the World Gold Council IMF data and central bank balance sheets show ongoing purchases by institutions such as the People's Bank of China, the Central Bank of Turkey, the Reserve Bank of India, the Monetary Authority of Singapore, and several emerging market central banks. These banks are not trying to time the market. They are not buying gold for short-term profit. Central banks buy gold because it has no counterparty risk. It does not depend on another institution's promise. It settles outside the dollar system. When trust in financial intermediaries becomes less reliable, that difference becomes extremely important. Regulation adds another layer to this story. Basel III is often described as a post-financial crisis reform meant to strengthen banks. That description is accurate, but one specific change stands out. Under the net stable funding ratio rules, allocated physical gold held by banks can now be counted as a Tier 1 asset. Paper gold does not qualify. Unallocated gold does not qualify. Only physical metal with clear ownership and custody counts. This changes how banks think about gold. It is no longer treated only as a commodity exposure. It becomes a balance sheet stabilizer. When regulators and banks quietly agree on this classification, they are not reacting to headlines. They are preparing for stress. Market infrastructure confirms this shift. COMEX inventories are divided into registered gold, which is available for delivery, and eligible gold, which meets standards but is not committed for delivery. Over time, registered inventories have steadily declined. This does not mean gold has vanished. It means holders are choosing not to make their gold available for delivery. In simple terms, this shows a preference for holding metal rather than trusting paper claims. When confidence is high, leverage expands, and paper claims multiply. When confidence tightens, assets move closer to their owners. That shift is visible in the data. Gold's price behavior also tells an important story. Traditionally, gold moves lower when real interest rates rise. Higher real yields increase the cost of holding a non-yielding asset. Recently, that relationship has weakened. Gold has remained strong even during periods of rising real yields. This suggests gold is no longer priced only as an inflation hedge. Instead, it is increasingly priced as a monetary asset valued for reliability and settlement certainty. The market is not reacting to consumer prices alone. It is reacting to trust. Globally, currency fragmentation is slowly increasing. More trade deals are being settled outside the US dollar. Local currencies are being used more often in energy and commodity transactions. Some countries are discussing gold-linked settlement mechanisms. None of this replaces the dollar overnight. The dollar remains dominant, but dependence is slowly being reduced at the margins. In such an environment, gold acts as neutral collateral between systems that do not fully trust one another. This is not political. It is mechanical risk management. History offers a useful comparison. In the late 1960s, gold quietly flowed out of U.S. reserves under the Bretton Woods system long before the public understood what was happening. The system did not collapse suddenly. It weakened slowly. Confidence failed last. Today, there is no gold window closing. But the behavior feels familiar. Official institutions are adjusting their positions before stress becomes obvious. Timing matters more than an ounce immense. Several forces explain why this is happening now. Government debt levels are extremely high, limiting policy flexibility. Geopolitical tensions have reduced trust between major economies. Financial markets have become highly sensitive to liquidity disruptions, where small problems can spread quickly. In such conditions, systems rarely fail overnight. They adapt first. Gold is part of that adaptation. Another important piece of this story is the internal structure of the gold market itself. Gold is not just a price on a chart. Behind the scenes, it is part of a complex system involving leasing, swaps, rehypothecation, and interbank transactions. When trust is high, multiple paper claims can exist for the same ounce of gold. When trust declines, this leverage begins to shrink. Physical gold becomes more valuable than paper exposure because it guarantees settlement. Gold leasing activity also reflects this change. When leasing is active, it suggests confidence in short-term liquidity. When leasing slows and physical gold is held back, it suggests a defensive posture. Institutions prefer certainty over yield. This behavior does not appear suddenly. It builds gradually. The relationship between London bullion markets and COMEX also shows quiet changes. Under normal conditions, arbitrage keeps prices aligned. When delivery timelines stretch or physical movement slows, it signals that liquidity exists on paper but is tighter in reality. This does not mean failure. It means stress at the margins. Gold repatriation adds another signal. Countries like Germany and the Netherlands have moved gold back into domestic storage. These moves were not dramatic. They were administrative. Institutions increase custody control when future conditions feel less predictable. Gold derivatives also deserve attention. The total value of gold derivatives far exceeds the amount of physical gold available. This system works as long as most contracts are cash settled. But when interest in physical delivery increases, assumptions are tested. Confidence becomes the most important asset in the system. Monetary policy adds further pressure. Higher interest rates create short-term stability, but they also increase debt servicing costs. Governments and central banks have less room to maneuver. In this environment, assets that carry no policy risk become more valuable. Gold fits that role. It is important to understand that gold usually moves before crises become obvious. Institutions reposition early. By the time the public notices, prices have already adjusted. Gold buying today is not about panic, it is about preparation. Most gold buying is coming from countries looking to diversify away from heavy dollar dependence. This is not an attack on the dollar, it is balance sheet diversification. Overconcentration reduces resilience. Gold reduces that concentration. There is also a psychological element, but for institutions, psychology means risk perception, not emotion. When several low-probability risks begin to align, institutions increase insurance. Gold functions as insurance against system stress. These signals do not appear all at once. They build slowly. Each quarter, each regulatory update, each reserve report adds another layer. Eventually, a pattern forms. That is where we are now. Gold is not breaking the system, it is revealing the system's limits. It acts like a mirror. When confidence is strong, gold is quiet. When confidence stretches, gold begins to speak, without making noise. Financial systems change through administrative adjustments before they change through events. Rules evolve, balance sheets shift, reserves move. Gold connects all of these changes. This is why viewing gold only as a speculative asset misses the larger picture. Gold is a signal, a slow, deliberate institutional signal, and when multiple signals point in the same direction, ignoring them becomes risky. What we are witnessing is not a sudden crisis. It is a gradual transition. Confidence is becoming conditional rather than absolute. And when confidence is conditional, neutral assets naturally gain importance. That is why understanding gold today matters not just for investors, but for anyone watching the financial system closely. Gold often reveals what policy statements do not. At this moment, gold's behavior is not just about price. It is about the future structure of the financial system, a structure that is being rewritten quietly, line by line, before most people realize it has begun.